Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, also a portfolio manager and our chartered market technician. Thank you so much, as always, for giving us a few minutes of your time. I know these are a little bit heavier moments, but we still are very systematic in the way we go through information on a weekly basis, digest it, make decisions, and share what we can with you along the way. So, Andrew, thank you for coming on board here. It's been nice having both of us on here each and every week, and having you a part of this process.
Yeah, thank you.
Yeah. So this week we're going to jump off. Actually, I talk about a few things. We're going to talk about sectors in focus, risk appetite. So now that we've really seen some dramatic shifts in the market, one thing we always turn to is what's the level of risk taking out there? What is the investor sentiment and appetite? And then lastly, a continued look at commodities as they are a focus group. So starting with sectors, and actually on that commodities front, we had a great question this week. And the question was, why haven't we seen sectors be or commodities be one of the sectors in focus? So first, we'll just take a look at which sectors we have in focus. And right now you'll see that to be energy, financials, and staples. And we'll have Andrew kind of go over the methodology and what this means for our investment process. But first, really what we're looking at when we say sectors. When we're talking about sectors, we are talking about groups of stocks. So that's the first and foremost thing, is that one of the biggest and most important investment questions that we have are how much to put in each of the main asset class. And by asset class, we mean stocks, bonds, cash, and commodities. So commodities is a separate asset class from stocks. So when we're talking about sectors, we are specifically talking about different groups of sectors. And in my 20 years in the industry, that number of sectors has grown. As sectors and industries have evolved and changed, they have split some off into the fact now that I think we have 11. I actually lose count, and I think there's talk of splitting them up further. But in total, there's 11 sectors, and we divvy them up, and we pay attention to how we're allocated across them. We want to be diversified, but we also want to focus on those that are most important. And that's where Andrew and his tools come into play to help us get that allocation right.
Yeah, so we've spent the last couple of weeks, we were talking a lot about the risk barometer and how we take it. That's kind of our approach to the broad market, our total equity allocation. Kind of the next step after that, as Adam as eloquently described, is kind of looking at the sectors. So if we know, okay, we want to have some equity exposure, where do we want to get that equity exposure? And so the first step is looking at from a sector viewpoint. And as kind of a theme with a lot of the analysis that we do, we want to take a non-emotional, a data-driven approach to that. And so with the sector overlay that we use to get the sectors in focus, those top three that Adam talked about currently being staples, financials, and energy, we're looking at kind of the trend of each one and looking at the sustainability of that trend. Essentially, we will run an algorithm that I built, and we'll look at it every month and say, these are the trends that are likely to be most stable over the next month, continue to be higher in the sectors with the highest score. Whatever that algorithm has said to be, those are the sectors then we allocate. Last year, we were in big chunks of the time in technology because those were some of the best area was technology. Right now for February and March, it's been energy. And that's been one of the overweights for last month and this month because that's been one of the stronger sectors. And so there's a lot of different inputs. We don't need to go into the minutia of it. But the main takeaway is it's a systematic approach to evaluate all the sectors, compare them to each other, and see which ones do we systematically view as the most favorable. And then we can start either looking for individual opportunities in individual stocks or just use ETFs to get that exposure. And that's the conversations that we have each month.
Yeah, very well said. And specifically for those of you latching on to the commodities, it is worthy of note that there are sectors that focus on the production and distribution of commodities, the biggest of which in the United States is energy. Depending on which index you look at, about 50% of the commodity complex is energy. And that is one of the three sectors we're focused on. The other main one in the S&P sector group is basic materials. Earlier this year, we did have rotation in on basic materials, which is responsible for a lot of different things, but there is a lot of commodity production and manufacturing inside that group as well. Okay, so transitioning now to risk appetite, something, then again, this is along the lines of technical analysis and something that we really want to pay attention to when we reach extremes. So, Andrew, back over to you and your chart here and what this
And
means to the viewers.
yeah, so risk appetite is kind of one way to evaluate how aggressively bullish or how aggressively bearish are individual investors. And so different ways to look at that. Today we're looking at it's about 18 different ratios. So there's different parts of the market that should show good relative performance relative to others when we're in kind of more risk on, a high risk appetite. People are really motivated to be buying stocks, and there's certain things that should outperform during those periods. Traditionally, you'll see small caps will do really well. You'll see kind of those technology, financials, energy sectors will do well. Certain commodities do very well. We want to see our international markets outperforming. So we'll look at all these different, there's 18 of them at different ratios to determine are the things that should be outperforming, are they outperforming? And so that's what this chart here, we look at the S&P 500 on the top panel, the average of those 18 ratios in the middle, and then the actual number of them that are in the top half of their 1 year percentiles at the bottom. What we want to focus on today is that middle line, and that's the average of all the risk appetite ratios. When that line's going higher, that means that risk appetite's healthy and that it's improving. We can see that it bottomed during the COVID crash in 2020 and steadily rose through just till it got to about 2021 and then started to tail off. The fact that it was going down wasn't a huge concern, but once we broke that 50th percentile threshold, that's when we started getting a little bit more concerned. That was telling us that the market is starting to step back, become a little bit more cautious. Risk appetite maybe isn't as ferocious as it was at one point. And unfortunately, we're continuing to see risk appetite decline. As of Friday, which is as this chart is through, it actually made a new low for the year, a new multi-month low. And so we're continuing to see investors are becoming a little bit more cautious. Risk appetite is starting to continue to be pulled back. And that's kind of been the theme for 2022. Obviously, we don't know how long that will last. Maybe it will start to reverse and the data will improve, and we welcome that. But as of right now, risk appetite does look to be like investors are starting to batten down those sales a little bit and aren't as aggressive as they were during most of last year.
Got it. Okay, now commodities have been something that have been a topic of focus, growing and increasingly so. And for a number of different reasons. But we're going to round this out today with two more commodity points. And, honestly, the reality is they're not great points because there comes a point when commodity costs go up substantially, right? They take a big chunk of income expenditures. And unfortunately, it's really disproportionate to the lower incomes. So it's a very regressive sort of move. Because lower incomes have a bigger proportion of their household expenses go towards commodities. But nevertheless, our job is to analyze this and make the best of it that we can. But we want to put up and talk about agriculture specific. Again, commodities have their own little sectors. But really what we've seen is the Russia and Ukraine situation has escalated. It's really hit this group along with energy, of course. Very acutely. So, Andrew, this is a composite, as I understand, of ag and livestock.
Yeah, so you have your corn, wheat, soybeans, cattle, hogs, all the things that would kind of fit in that ag and livestock. And you can see for a long time, this goes back to 2012, really since 2013 through 2020, this was on a steady decline. Agricultural commodity, as an aggregate, the prices were going down and kind of then steadied over the last probably 5 years. They kind of flattened out a little bit, as you can see on this chart. And then since kind of the COVID era began, we started seeing prices rise. You started having limited supply. All the supply shocks you're seeing in other parts of the world were impacting commodity markets as well. And then it only really intensified here recently as the invasion of Ukraine. Ukraine's often actually described as the breadbasket to the world. They provide a lot of agricultural products to many parts of Asia and Europe. I believe they provide about 10% of the wheat to the globe. And so as you start having as the invasion, you're starting to decrease the the issues even, or starting to intensify even more. And you're seeing a lot of those individual commodities are starting to just go parabolic straight up as prices really start to rise significantly. And that's going to have kind of rippling effects on food prices here at home as well as internationally. And we go on and on kind of about the impacts there, but this is definitely something we want to be watching. And it is a concern, as Adam said. Hopefully this isn't a trend that lasts for a significant amount of time. Unfortunately, we think it probably will last a little bit longer than just a couple of weeks. But the ag market and livestock, the pass through, like Adam said, this is disproportionately impacts lower income. They spend about 20 to 30% of their income on food products. And that's going to have an impact on economic growth and consumer spending and on and on. And so that's why we really want to watch the ag prices because it can have an impact on economic growth and cross over into what's going on in the financial markets.
Well done. And some good news here is that as it is with commodities, the weather plays such a big impact. All right, so the good Lord really will determine what happens from here. And just as we go to planting season in the United States, and it remains to be seen what happens. And hopefully we're blessed with a great opportunity to help fill that gap for the world, and at least the commodities where we're big producers, and of course other places around the globe. But as we package that and translate it into what it means in terms of an inflation number, right? So one of the biggest consumption pieces is food. So what that means to us in terms of its impact on inflation. So the food at home component, and directly as it relates to the food component of CPI, it's contributing 1% to the overall inflation. So as we've seen the overall number for inflation drift higher, a whole 1% of that has meant inflation. And before we close today, Andrew and I were talking as we were teeing up the video. It'd be worthwhile to spend a couple of minutes talking about a question that we've gotten, and it's a worthwhile one. Is, hey, a lot of these things that we've talked about recently have been on the negative side, and the risk barometer has moved to defensive, and we've seen trends change into the negative, and that's data that we take in, and they're just facts, and we use them to help position the portfolio and accordingly. But the question then becomes, why don't we have even a bigger adjustment to cash? Why don't we have a bigger adjustment and a bigger cash stockpile to weather this storm? And there's a lot of different answers to that question, but it's so important in terms of our process and the way that we view this world. But we'll hit on a few of them together between Andrew and I, because we'll cover it from different angles. But first and foremost is we want to be diversified in everything that we do. To go all into cash is really placing all of our chips. Just because we have information that points us to being defensive, we have no crystal ball in terms of what the market will do. It just sends to indicate that the risk conditions are higher now than they normally are. That doesn't tell us what the market is actually going to do. And in fact, when we do rebound, we saw it in the COVID crash. We saw it in 2009. Rebounds can be fierce. If you missed the first 3 or 4 weeks in 2009, if you missed the first 3 or 4 weeks in 2020, you missed the lion's share of the rebound. And in fact, we begin to get into a psychological trap there. You see so much of the gains come so quickly, you think that the market's overdone and you'll continue to sit it out. And then you just kind of continually keep yourself out of the market. So we're really trying to manage the psychological impacts as well. And so, Andrew, I think I'd ask you to add your 2 cents in here and why we don't want to go all in or all out of the market in this case.
Yeah, I think kind of looking back at during the COVID crash in March, where you had the entire globe came to basically a standstill. And that only lasted really 4 weeks. Obviously, COVID had much longer implications. It's still around today globally. But from a market standpoint, we began to rebound just a couple weeks later. So I think when you do an all in or all out call, you have to get it right on both ends. You have to get the timing correct on both ends. And like Adam said, the psychological component, that's very tough. There's always, when you make a choice to go into all cash, you begin, and what we see very often with clients and economists and other portfolio managers is it's very easy to justify and continue to find reasons to justify staying in that position, where you look back and it's now been years for some people where they're constantly finding something negative to pick at, saying this is why it could keep going, because they want to be proven right. But instead, we'd rather have a diversified approach, not only to the assets we hold, but the strategies we use, and recognize there are still going to be some potential opportunities within the market. A very old saying in Wall Street is there's always a bull market somewhere. Today, it's kind of commodities and energy. We talked about that already today. And so we want to maybe get some of that exposure kind of with like our sector overweight, where we're getting some exposure to energy, because those prices are still going higher. So we want to manage our expectations, manage the short term, and that's what we're always in day to day, is just the short term price changes, while still trying to stay on track longer term. That's what the risk barometer does help, as we do begin to get a little bit more defensive, but not make all in or all out bets or plays, because the success rate there is much harder to hit, and that's what we try to avoid doing, those big moves like that.
Yeah, and just historically, what I've observed from being in the industry, what I believe has always been the case in the past, and for that matter, probably will be the case in the future. Who knows what it actually holds? But markets don't rebound when things look better. They don't begin to bat. We don't get a heads up to say, hey, the sun is shining, the data starts to look good, and we're growing, so the market's free to resume. The stock market has always been the leader, and we've seen big spikes. It seems like you're still in the middle of a big bad bear market or decline, or correction, whichever one of those two that you're in. Market jumps first and fierce, then you begin to see the other data turn around. So, like things in our risk barometer, we're looking for things to get less bad, et cetera. But it still looks bad, and we can justify that all cash psychologically from investor sentiment. So we just want to spend a few extra minutes on that. And if you have remaining questions on that or want to discuss that further privately with Andrew or I or your advisor, please, by all means, call us, 800-928-4001. We're happy to chat about that. And also don't forget our radio show, which is a weekly event over the airwaves on WIBC or through podcast form. Hey, thank you again, and everyone have a great weekend.